They might be they'll essentially become potential profit targets. So here's the setup. Again, I told you this is super simple. Here's the setup. And I'll even kind of list it in a 1, 2, 3 kind of way, because I like having these lists. You know, I have 1, 2, 3, 4 steps for every one of my setups. So here's the 1, 2, 3 for 5 minutes. Number 1, and I cannot stress number 1 enough. You want a good, clear reading on a 5-minute chart of either an uptrend or downtrending wave angle, 12 to 2 or 4 to 6. What does good clear basically mean? It goes back to that clarity. How do I read the clarity of the wave? I want it to be smooth. I want prices to respect the wave if it has been tested, and I want it to be established in that order. That's the order of priority. Smoothness, I hope you see by now, it's absolutely the first criterion, the most important. That means a lack of bumps and wiggles. We don't like bumps. We don't like wiggles. Okay? So the fewer they have, the better. And again, we go down the list, respecting on the wave support or resistance if it has been tested and established. Okay, that's number 1. Good, clear, 5-minute uptrending or downtrending wave angle reading. Number 1. Okay, number 2 would then be going to the appropriate up or down, which is our green or red background chart. So now what we're doing is we're taking the fact that we recognize an uptrend and we're going to that green background chart. Or if we have a downtrend, we're going to the red background chart. You have to go to the appropriate chart because there's that slight nuance with the 34 period EMA, right? Other than that, they're more or less the same. So we go to that appropriate chart. Third step is we go to, well, basically we've gone to the chart, now we're waiting. Third step is basically waiting. What are we waiting for? This is the entry. We're waiting for the entry, and here's how we define the entry. You'll hear me refer to it as between the greens. Because really all we're waiting on are prices if they're heading up, if the markup cycle, that means we're going to the green, if they're heading up, we want them to pull back in between the 13 and 21 period EMA. So we're waiting for a between the greens pullback. If prices pull back to this area between the lime and the medium sea green, we buy in a markup cycle. Again, 12 to 2 o'clock market cycle. You go to the green background chart. You wait for prices to come back to, in other words, retrace or pull back, correct, to the support between the 13 period and the 21 period. This is the 2 green lines. And then we buy between the greens. What I like to usually see is prices actually kind of come, through the 13 and in between the 21 and the 13. That's why I call it between the greens. Not at the greens, but between the greens. All right. Okay. So then, once that happens, and by the way, just from my experience and what I tend to do is I'll use limit orders at the price of whatever the top line here, the lime green is, for my buy. So what I'll look to do, and again, remember, if you're trading during volatile market conditions, your orders may not be placed as you were hoping. They may not be filled as you place them. The orders may not be filled as you place them. So again, I mentioned that I don't like using this setup during economic reports. I'll get out before the report. I'll get in after the report. I don't want to be in the market during the volatility of an economic report. I don't want to be trying to fill my order with the melee, the market volatility of the economic report. Okay? So when I'm talking about limits here, remember, I'm not trying to engage the market at an 8:30 Eastern hot zone or a 9:15 or a 10 o'clock hot zone. I'm not looking to trade economic data with this approach. I want to avoid those volatile market conditions as much as I can. Okay, because again, remember, these fast-moving conditions, your stop losses, your limits, all these type of orders may become they're just going to be subject to the kind of price movement, the volatility you're going to see. So why even open yourself up to that, especially in a short-term time frame? Not worth it. Not worth it. Okay, my opinion. That's the way I like to do it. I like to avoid those times. Okay. All right. So if the market was heading down, and I don't know that we have a downward trending market, but if the market was heading down, okay, let's just kind of use this. Again, these aren't great examples, I have to tell you. Right now we have the Asian session, so these aren't necessarily great examples. But one of the things to keep in mind is, with the 4 to 6, we go to the red chart. Okay, so let's go to that Aussie yen here on the red. All right, so what am I looking at for 4 to 6? 4 to 6 o'clock, downtrending market. I'm looking for prices to bounce, to correct, to retrace between the greens. It's still between the greens, right? So if prices come up here, I'll, again, probably have a sell limit waiting at whatever price the lime green or the 13-period EMA is. And what I would need then is for price to come up just beyond it, so I'll end up between the greens, and that's where my sell limit will trigger. That's the way I like to do it. Okay? So when prices bounce up here, I get a between the greens short sell within the context of a 4 to 6 o'clock market cycle. So again, between the 13-period EMA and the 21-period EMA, as prices bounce. That's what I'm looking to take advantage of. Downtrend, red chart. So the entry is not complicated here, gang. I mean, it's very mechanical because we don't have the luxury of time. So I'm looking to short this area. I also want to take into consideration a few things, and those are things like key market levels, like if there's a pivot somewhere within this area, if there's a psychological level somewhere within this area. In fact, there's a psychological area factoring in near 84 around this area. Okay? So those are things that I want to be aware of. I don't want to ignore them. Let me show you here. I don't want to ignore them. Okay, so I've got this 84.00, which could be resistance factored in. I know that the resistance below and above the 84 could be as low as 83.95 and could be as high as 84.05. So I know I'm in that 10 pip wiggle of this area, but I always want to at least know that I'm near 84 and that prices could run into selling pressure or buying support, whatever the situation may be. In this case, it would run into selling pressure as it's moving up. It would move into buying pressure as it's moving down through. So I just want to be aware of this. I want to be aware of psychological levels like the 00, the 50 pip, the 20 pip, the 80 pip. I want to be aware whether I'm going to be near a pivot level of some sort. Okay? On my chart. Is there, for example, here I can see I do have a pivot level that I'm going to be dealing with. I have an R3 right here, 83.95. Okay, that could be support. Even though it's a resistance level, when we're coming back down on resistance, it's now support. What was once resistance becomes support. What was once support comes resistance. That's support and resistance 101 in charting. So again, on the way up it was resistance. On the way down it could be support, 83.95. Got to know these things. Psychological levels, pivots, they just are. I don't have to make any kind of analysis, decisions about where these levels are. Okay? If I'm utilizing the IBFX daily pivots tool, which you can download right from the IBFX.com site, if I'm utilizing that tool, it's automatically overlaid. I don't have to make any decisions about it. Psychological levels, again, I can be aware of these simple numbers, the 00, the 50, the 20, and the 80 pip levels. Okay? Same with my moving averages. I'm not making any difficult decisions about where they are. They're right there overlaid on the chart. Okay? That is the entry. Very simple, right? So that's how you get into the market. That's the process. So let's transition over to trade management, to risk management.